2022 has been a tough year so far. The economy has been hit from all fronts. From multi-decade high inflation to aggressive monetary policy by the Federal Reserve, and the effects of the war on Russia. All these have caused extreme turbulence in the stock market. The resulting fears and widespread economic slowdown have impacted even the most profitable of names. Given the current macroeconomic backdrop, investors around the world are cautious about investing in stocks. With a possible recession still looming overhead in the midst of the ongoing bearish sentiment, investors are having trouble finding the best stocks to place their bets on. Despite such pessimism in the market, there are plenty of burgeoning opportunities to capitalize on. Bear markets like the current bring forth the opportunity to buy great growth stocks for a much lower price. Thus, to help you identify some great buys for the month of October, we have compiled a list of 5 stocks worth considering. First in line is a high-growth chip stock coming at a pretty low evaluation, Qualcomm Inc., which trades under the ticker symbol QCOM. Based in the US, Qualcomm is a leading wireless technology provider. While the company is best known as a leading supplier of chips to the smartphone market, it is also the main driver of the development, launch, and expansion of 5G technology. Qualcomm has a broad portfolio of products and services including those for processors, modems, platforms, RF systems, and connectivity among others. In addition to its smartphone chips development, the company's auto business pipeline size has tripled, from just $10 billion to $30 billion. Even better, Qualcomm now sees its total addressable automotive market of $100 billion by 2022. Moreover, the company is also a chip supplier for Meta Platforms' Oculus headsets in the metaverse sector. On the financial front, Qualcomm did great in its latest earnings, with revenues jumping to $10.9 billion. The revenues improved by a nice 36% year-over-year. Furthermore, the adjusted quarterly earnings grew by over 53% year-over-year, to $2.96 per share. Down nearly 35% year-to-date, the stock trades for a single-digit forward price-to-earnings multiple of just 9.5. The company also pays a dividend with a yield of 2.5%. Hence, with an expanding presence in some great markets, an inexpensive valuation, and a nice dividend payout, Qualcomm is a great buy for October. Added plus, its average price target from analysts represents an upside potential of 55%. The next stock in our list belongs to the travel resurgence space, the US-based Travel Plus Leisure company, formerly known as Wyndham Destinations Incorporated. Trading under the ticker symbol TNL, Travel Plus Leisure is a leading membership and leisure travel company throughout the world. It provides hospitality services and products in the US and internationally, with nearly 20 brands in its resort, travel club, and lifestyle portfolio. While the pandemic impacted the company negatively, its business model resiliency combined with customers' desire for travel has proven to be a great tailwind. According to the company, its bookings, the number of reservations and stay length have remained robust in the second half of 2022. The strength of consumer demand has even resulted in the metrics rising above pre-pandemic levels, with average volume per guest shooting 40% above pre-pandemic levels, and the average length of stay rising 8%. In the second quarter of 2022, Travel Plus Leisure reported a net income of $100 million on revenue of $992 million. The adjusted EBITDA was $230 million in the quarter. Moreover, the company expects adjusted EBITDA of $230 to $240 million for the ongoing quarter, and $860 to $880 million for the entire year. Additionally, the stock is currently trading at an unusually low valuation in the hospitality industry, while being the giant that it is. Travel Plus Leisure trades at a price-to-earnings ratio multiple of 8.26, which is well below the industry average of 16.59. and throw a mean price target upside potential of 58.7% into the mix, and you get another great buy for October. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Coming up next is a leader in the entertainment industry, the Walt Disney Company, with the ticker symbol, DIS. Despite being a source of joy to families across the globe, shares of the company have had a rough patch so far in 2022. While things are a bit dull at the moment, Walt Disney brings much to the table to ensure its place as a leader. The company has a strong competitive edge over its peers, as it can traverse generational gaps and connect its users. From bringing together grandparents and grandchildren through its massive content library, to bonding friends and families in its theme parks, Walt Disney is a giant with incredible pricing power. Its streaming platform, Disney Plus, is well on track to be a long-term growth driver. Disney Plus had amassed 152.1 million subscribers by July 2022, which is a milestone it achieved in less than 3 years, while it took Netflix over a decade to do the same. Disney Plus grew its subscriber base by 31% year-over-year in the quarter. Walt Disney's core business segment also saw robust growth in the fiscal second quarter, with revenue more than doubling to $6.7 billion. Additionally, the company also seems to be working on expanding Web3 across its ecosystem, as it recently posted a job listing for a principal counsel specializing in NFTs and DeFi. In short, while hurdles exist in the near term due to surging inflation and economic slowdown, the long-term prospects for both its streaming business and theme parks are very promising. It would be a loss not to add this stock to one's portfolio at a time when it is down over 35% year to date. Our next stock is an automotive retailer, Lithia Motors, which trades under the ticker symbol, LAD. Lithia is the largest franchised auto dealer group in the US, offering new and used vehicles as well as related services. At the end of last year, Lithia offered 40 vehicle brands across 278 stores in 22 US states, and 3 Canadian provinces. The company also runs an online retailing platform, Driveway. Lithia has been creating shareholder value through its best-in-class operations, and numerous acquisitions at attractive returns. The latest from the company includes expansion in the North Central region, completion of second Driveway finance offerings, and a new Driveway technology debut. Driveway recently activated a state-of-the-art strategic platform, Freeway, for bringing ease and efficiency to customers. While Driveway is not generating any earnings right now, but it has the potential to become a major contributor in the years to come. Lithia's existing extensive infrastructure gives Driveway the necessary edge that smaller dealers would struggle to replicate. Lithia is one of the fastest growing companies in the US, with revenue and earnings growing at compound annual rates of 23% and 32% respectively, over the past decade. In the latest earnings report, the company's revenues surged by 20% to $7.2 billion, while adjusted earnings improved by 12% to $354 million. Management expects the earnings per share to be between $55 and $60 by 2025. Therefore, trading at a price-to-earnings ratio of just 6 times the 2022 estimate, Lithia stock is genuinely cheap to buy in October and hold on to. And the final stock for today is a top player in the biotechnology sector, Vertex Pharmaceuticals, trading under the ticker symbol, VRTX. Vertex has proven itself to be recession-resistant, given its positive return of over 61% in 1 year, despite the huge market downturn. It is the largest public business in the world devoted to curing rare diseases. On top of it, Vertex has a monopoly in the market for therapies, addressing the underlying cause of cystic fibrosis. The company's unique strategy of targeting illnesses with none or few safe and effective treatment options has proven extremely successful so far. But that's not all the company does. Vertex is also developing drugs for more common diseases like type 1 diabetes. The company and its partner, CRISPR Therapeutics, are currently working on the regulatory approvals of exa-cel for treating sickle cell disease and transfusion-dependent beta thalassemia. This could most likely become the first ever gene editing therapy to make its way to the market. Furthermore, Vertex's earnings growth has even caused analysts to call it the best growth story in large-cap biotech. In the second quarter of 2022, the company came out with product revenues of $2.20 billion, a rise of 22% year-over-year. Net income grew about 12-fold and the balance sheet remained strong with $9.3 billion in cash and equivalents. With an attractive valuation of the price-to-earnings to growth ratio of just 0.38 and strong growth prospects, Vertex is one of the best stocks to buy in October. That's all from us in today's video. We hope that the insight we aspired to provide you will prove helpful in upgrading your portfolio. We would love to know your thoughts about our list in the comments section below. If you are interested in gaining more such information about stocks and various investment opportunities, do check out our website, stockstelegraph.com.